How can young investors build a dividend growth stock strategy that will serve them well for a lifetime and give them good income when it's time to retire? Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, a.k.a. Mr. Valuation. In a recent video, I was asked an intriguing question where I got really a suggestion for a video from a younger subscriber, and I thought it was a really interesting suggestion. So I went ahead and did some work and some research and drew from my own long-term experience as an investment advisor. And I put together this video where we'll learn how a young investor, say that has at least 30 years to invest, could build a dividend growth stock strategy that would meet their needs a long ways into the future, and one that they could follow and use for their entire lifetime. Let me read you the question, if you don't mind, if you'll excuse me reading. I suggest the following strategy to do a video about dividend growth investing from a perspective of a young man, 30 years old, who does not need the dividend income for at least 20 years from now and strives to build an income of approximately $2 per month in 20 years or more. All right, that's a kind of an intriguing question. So I'm going to do a presentation here for you about building the strategy, and then I'm going to look at some examples utilizing the FastGraphs Fundamentals Analyzer software tool on some examples and varieties of different type of dividend growth stocks that investor or a young investor can choose from. And I do want to tell you there's a lot of nuances to this kind of strategy, but there are some basic principles that are necessary and required to be not only adhered to, but to be understood and then applied over the lifetime. So let's go ahead and get started. Let's start with a little presentation I've created for y'all. Smart dividend growth investing strategies for 30-year-old investors. The introduction: dividend growth investing is a long-term strategy. That's a really critical point. It focuses on buying shares in companies known for regularly increasing their dividends. Another real key point, this idea of a company that consistently increases their dividends. Now, for a young investor, particularly a 30-year-old who does not need the dividend income for at least 20 years, this strategy can be an effective way to build a substantial income stream over time. With this presentation, I outline a comprehensive strategy to achieve approximately $2,000 per month in dividend income in 20 years or more. Now, I want to add here that there's flexibility and nuance here, depending on how much capital the person starts with, how much they commit every month, what type of stocks they choose, whether they're high yield or moderate yield. This number can be altered to $3,000 or $4,000, but it has to be within reason, as I'll bring up here in a moment in the presentation. Now, the key components of a good dividend growth investing stock strategy is, number one, focus on companies with consistent dividend growth, and with consistent dividend growth over long periods of time. As an investor, you want to have a long-term investment horizon. I'll be talking about how predictable dividends are, how unpredictable stock prices are, and how unpredictable market forces can be over the short run. But in the long run, the dividend will matter and matter a lot. Diversification is critical because you want to make sure that you're diversified amongst different industries, different types of stocks, etc. And we'll cover that in detail. Reinvesting of dividends. If you don't need the income, which was part of the strategy, it just makes sense to reinvest them. And reinvesting dividends actually takes advantage of the principle of dollar cost averaging. When stocks are expensive, you buy fewer shares. When stocks are cheap, you buy more shares with your dividends. But the discipline of doing it every time the company pays a dividend is what makes the program work. Regular savings and investments. Now, we'll talk about that. That means extra contributions or additional contributions over time. The selection criteria for dividend stocks is a little more nuanced. There's a lot of options you have, and I'll cover those. The use of dividend growth ETFs can be an effective way to do it, but they do have some issues, and I'll talk about that. And then regular portfolio reviews and rebalancing. I've often said there's no substitute for comprehensive research and due diligence continuously. Okay, you have to monitor your portfolio and work on your portfolio. You just can't set it and forget it like the old Ronco commercial used to be, for those of you who know what that means. So let's start. Number one, let's focus on companies with consistent dividend growth. because investing in companies with a solid record of paying regular increasing dividends is crucial. Okay, this is where your predictability comes in. This is giving you the ability to have a great deal of confidence you're going to achieve your goals. These companies often exhibit strong fundamentals, solid business plans, and a deep commitment to their shareholders. Raising the dividend every year for a long period of time is a real testament to this idea of having a commitment to their shareholders. So this approach not only provides a reliable income stream, but also tends to result in higher returns and lower volatility compared to other stocks, one of the true advantages of dividend-paying stocks. Now, this idea of a long-term investment horizon, remember, we're investing for 20 years or 30 years or even more. So this dividend growth investing strategy, it's not for those seeking quick profits. It's not a quick profit strategy. It's a long-term strategy that leverages the power of compounding. By reinvesting dividends, investors can significantly boost their portfolio's growth over time, and that's simply because when you reinvest a dividend, you're buying more shares of stock, which generates more dividends, and again, you're taking advantage of the dollar cost averaging principle. Now, this is particularly beneficial for a young investor who has a long investment horizon. Time is on your side. Well, I've often said, and you've often heard this, I'm sure, because I'm not the only one that says it, is market timing is not what's important. Time in the market is what's important, and that's why a strategy like this with a long-term investment horizon works. Diversification. You want to spread your risk. So diversifying your holdings across various sectors is essential. Because even though the market can be hot, you have certain sectors that are doing poorly, certain sectors that are doing good, etc. So a well-diversified portfolio should include stocks from different industries. For example, industrials, energy, healthcare, consumer staples, consumer discretionary, and financials, which are known for their strong dividend growth. I might add here, you could also add utilities, which are not known for a lot of growth, but they are known for high yield, and that can help when you're trying to put this together to meet your goal. This diversification helps in spreading risk and ensuring a stable income stream. Reinvestment of dividends. Reinvesting dividends is simply a powerful way to accelerate portfolio growth, as I've already said. By automatically reinvesting dividends, you can purchase more shares, which in turn generate more dividends, creating a compounding effect. That's really it. Remember, dividends are paid on the number of shares, not the price of the stock. So the more shares you can accumulate over time, the more potential you have to meet your goals and objectives. This is especially effective, again, over a long period of time, such as 20 years or more. Regular savings and investments. Consistently saving and investing a portion of your income is crucial. Now, a lot of financial, quote-unquote, experts recommend saving 15 to 20%. I would agree with that, but if it's only 10%, if that's all you can do 10. If it's only 5, just do 5 during your working years. And as you get advancing in your working years, you may be able to increase that from 15 to 20 or 25 or 25 to 30. The more you save and the more disciplined you are in that saving, the better you're going to be in the long run. So this approach ensures that you'll have a substantial amount of capital available to you over time. The selection criteria. When selecting dividend stocks, focus on companies with a long history of raising their dividends, modest payout ratios, and strong financial flexibility. Now, I want to alter this a little bit. Higher yield stocks will have higher payout ratios. Lower yielding stocks will tend to have low payout ratios. My suggestion, and I'm going to illustrate, is to mix them up. Additionally, consider factors such as free cash flow, share buybacks, and earnings forecasts. In other words, know the businesses and know about the businesses and how you think the businesses you're investing in are going to be potentially able to perform over the long run. But again, that's no guarantee of that, but do your work. The use of dividend growth ETFs can really be a strategy for those who just want someone else to do it for them. And ETFs that specialize in dividend growth can be convenient. Okay, but these ETFs often include a broad range of companies with established histories of dividend growth, providing reliability and diversification. However, ETFs are essentially black boxes. You give up control when you do this, and you lose the ability to know whether the stocks you're investing in are fairly valued, overvalued, or undervalued at the time. Also, you lose the ability to see how the stocks are structured, what their quality is, and so on. There was an article in the Wall Street Journal just about a week ago titled "The Junk in Your Index Fund is Costing You Big Time." In other words, that's one of the negatives about ETFs, but they do work. And for people that just want to do it, kind of, again, a Ronco methodology, set it and forget it, you can use an ETF. But I prefer taking control of my own finances. And for those of you that do, then building an individual portfolio might be the ticket instead. Regular reviews and rebalancing. Conducting regular reviews and rebalancing ensures that it stays aligned with your goals. This helps you in maintaining the desired level of diversification and adjusting for any changes in the market. Any job is easier to do with the right tools, and I would argue Fast Graphs is the right tool to help you do this, especially with our new advanced portfolios for premium subscribers. As you'll see later in the presentation, that's really helps you be able to do that and make this job easy and simple, even if you want to build your own individual portfolio rather than rely on ETFs. Now, the practical steps to see a $2,000 monthly income are an initial investment in regular contributions. The more you can start with, the more you can regularly contribute, the better off you're going to be. And if you have to start regular contributions at a low rate and then enhance it to a higher rate, that still works. It's the discipline that matters. And you can also adjust according to how much yield and growth you're willing to take. You're going to get higher risk with higher growth and lower yield and vice versa. But you can have nuances, don't have to be all or none. And then be patient and have realistic expectations. Take what the market can give you and don't do things like chase yield. I think people get in trouble doing stuff like that. Now, the initial investment in regular contributions are pretty straightforward. You can start with an initial investment, $1,000, $5,000 if you got an inheritance or you were saving up money. It could be $5,000, whatever number it is. The bigger that number is, the better chance you're going to have of meeting your goals. And then investing like $25 a week into a diversified growth ETF or a portfolio of dividend-paying stocks will grow over time. And not just that it can significantly, it will if you stay disciplined. And by the way, the times when the portfolio's down in value, the stock prices are dropping, would typically be the time to get aggressive, not be defensive. In other words, that's when you really want to be excited because it's a long-term horizon. Target dividend yield and growth rate. Maybe you need to figure, if you do your math and amount, depending on the amount of money you start with, you might need a 3% yield, or you might be happy with a 1% yield that grows fast. And so the idea is you want to basically consider those things when you're putting the portfolio together. But you want to aim for a portfolio with a balanced yield. You can have some high yield stocks in, some lower yielding stocks, some high dividend growth stocks, some higher yielding, lower dividend growth rate stocks, etc. So a portfolio with an average dividend yield and a high growth rate can help achieve the desired income. You want to get your dividend growth rate as high as possible, again, being practical and taking what the market's going to give you. So with patience and realistic expectations, building a significant monthly dividend income portfolio can be achieved. It does require patience, thorough research, and realistic expectations. Can't repeat that too often. It is essential to understand that this strategy takes time and effort to yield substantial results. 6 months from now, your portfolio could be down, but 6 years from now, it'll most likely be up. So in conclusion, for a 30-year-old investor aiming to build a $2,000 monthly dividend income in 20 years, the key is a disciplined approach to dividend growth investing. By focusing on companies with consistent dividend growth, diversifying across sectors, reinvesting dividends, and making regular contributions, and even increasing those contributions over time as your economic situation changes, it is possible to achieve this goal. Regular reviews and a long-term investment horizon will further enhance the likelihood of success. So anyway, that's kind of a real quick map out of the strategy, if you will. But what I want to do now is I want to go ahead and turn to fast graphs, and I want to basically show you some real-life examples and try to crystallize what was presented in that presentation so that you can understand more clearly what it's all about. All right, what I've done here is I've created a portfolio with 11 stocks in the example using the Fast Graphs Fundamentals Analyzer software tool. Okay, the idea here is to just illustrate kind of some of the options you have. So I want you to notice that I named this view Variety. because again, you want to be well diversified and balanced in the thing. And I want you to notice there are, and from a variety, I've got companies here with significantly different dividend yields. I've got companies here that have paid dividends over various periods of time. But these are just examples. I want to have this be clear. I am not recommending any of these stocks specifically, although I think all of them are great stocks. These are examples of the types of choices you can make. And depending on when you start and what the market environment is, these would be kind of companies that you could look at if the valuations made sense. So I want to make that clear. Okay, so one of the things I'm going to do here is I'm going to start out by looking at an individual way to identify these stocks. In other words, a simple way to identify these stocks. What I'm going to do here is I'm going to go into my portfolio section of Fast Graphs. Okay, and I'm going to go to preset portfolios. Now, this is for premium subscribers of Fast Graphs. And maybe some younger people don't think they can afford it, but I don't think they can afford not to have something like this. But if you don't have Fast Graphs, what you want to do, there's a lot of stuff you can search for and find. For example, looking for companies with consistent dividend growth. There are lists that are curated by a friend of mine, Justin Law, who has the dividend champions, dividend challengers, and dividend contenders. Champions have increased dividends for 25 years. Dividend challengers have increased dividends for 10 years at least, but less than 25 years. And then the contenders are newer companies that have paid them for 5 years. And I'll have some examples of each of those kinds of characteristics. But you could also look at the Standard & Poor's Dividend Aristocrat list, which is a group of also very, very high quality companies. My point is, start your selection process looking for companies that have the characteristics that I described in the presentation. Extremely attractive records and dividend growth. So let's look at some of the varieties here. Now I want you to notice in the sectors, I've got healthcare, information tech, I've got 3 consumer staples, I got a couple industrials, financials, healthcare, I got 1 utility and a financial. These are just examples. This is not what I'm saying how you should build this, but I'm saying you can pick stocks from all these different sectors to give you that diversification. So let's start by looking at Aflac. Now, I'm also going to take advantage of the opportunity to answer some questions that we were asked in the recent webinar we did where we talked about how to use the Fast Graph screening tool because it kind of relates to this. All right, so I'm just going to do that. So one of the best ways for me to start this presentation out, especially for young investors who maybe aren't really cognizant or aware of the Fast Graph tool, I'm going to take the tool apart. Okay, I'm going to start basically. All right, so the first thing I want you to see is the operating earnings line. Now, you want to always check as a Fast Graph subscriber what the growth rate is. How fast does this company grow? Is it a fast grower, a moderate grower, or a slow grower? Okay, I would call Aflac a moderate grower, under double digit, but above 3 or 4 or 5%. And it's pretty consistent. There's a little cyclicality in earnings growth, but it's been pretty consistent. Now, this is probably the second most predictable line you'll see on a stock chart like Fast Graphs that correlates the company's business fundamentals to its stock price. And stock price will typically be the least, and I'll make that point as I go. The second most important line, and so before I leave that though, the orange line represents a fair value multiple of the earnings listed below here. And the slope of this line is the 9.28%. Okay, so here we're seeing a company with consistent earnings growth at a pretty high rate, but there is some volatility. Okay, if I bring in the next and the most consistent line, and the one that I really want to focus on the most throughout this presentation is what I call the white line on a Fast Graph, or the dividend line. Now, Fast Graph's a very visual tool, and just by powers of observation, you instantly can answer questions that a lot of people had. One of them, like, what's the payout ratio? Well, the area below the white line is the amount of earnings. This green shaded area is all the earnings this company achieved. Now, I could also do this on cash flows and other metrics that are available in Fast Graphs, but the point is, from an earnings point of view, you can see that in 2004, Aflac paid out 16.5% of their earnings. You can see that the line was real low. out here higher, you can see that they paid out 28%. And you can see that the dividend has increased each and every year along this time frame. So you get automatically, just by using your powers of observation, you've identified a company with consistent long-term earnings growth. Okay, now you can simply click to the performance section of the Fast Graph tool, and it will tell you how fast the dividends have grown and compares that. Actually, I'm comparing that to CVX here, would also normally compare it to the S&P 500, but you can compare it to things is my point. And so that's a pretty fast growth for a dividend. Compounding at 13% is very attractive. Now, it's a mid-yield, 2.1% moderate yield stock. Now, it's very high quality, A- rated, has 25% debt. But this would be the kind of stock, the kind of characteristics that you would look for. But you could also, again, have nuances of these characteristics. Okay, so let's move on. Let's go into another stock. Let's look at Caterpillar next. Okay, Caterpillar would be an example of a real cyclical stock from an orange line point of view. I want you to notice how cyclical it is. Now, I also want you to notice when the cycle is bad, like we had these 4 years, all of a sudden the payout ratio for Caterpillar got up to 90%. In other words, this area below the white line is the portion of earnings they're paying out. The area above the white line is a portion of earnings that they've retained and used to run their business. So here we see a very high payout ratio, but then if I go back here and where the earnings are way above the white line, I see the payout ratio is only 21%. I see a rather high payout ratio here of 62%. I see a much lower payout ratio here of 33%. But I'm also seeing that the company pays out a portion of their earnings every year, and the earnings have grown. And here we've got a 12.69% earnings growth rate. And again, if I go to the performance record, I'm seeing very easily or quickly and easily that the dividend has been growing at around 11% on average or compound average growth each year. Now, there is cyclicality in this stock. So this would be one that if you were just had a real short-term focus, it could be hard to follow the discipline. So in other words, if I put weekly closing stock prices, you can see periods of falling prices, rising prices, flatline prices, falling prices, rising prices, falling prices, rising prices, falling prices. That's the cyclical nature, and that's where the dollar cost averaging comes in. When valuation would be real high here, your dividend would be buying fewer shares. When valuations are real low, like they were here, you'd be buying more shares. But that would be an example of a cyclical stock. Now, so I can keep up with everything, I'm just going to go ahead and go into alphabetical order here. I'm going to bring up Accenture next, and I'll try to stay in alphabetical order. Now, what you see here with Accenture is a stock that has a 12.66% growth rate, very similar to Aflac. It's AA rated, only has 7% debt. Now, the question would be if you were starting to build the portfolio, any time back here would have been a great time to add this stock to your portfolio when valuations made sense. Because another element of fast graphs, you got this dividend yield overlay here, and you can see when the valuations were low, this is the time where you would have been buying the stock with its highest dividend yields. But again, this is a moderate dividend yield, or 1.57%. But now if I go into the performance result, like I did before, real quickly, again, utilizing the Fast Graphs Fundamentals Analyzer software tool and just simply clicked on performance, I can very see that the dividend here has grown at like 19, almost 20% and 17% compound average dividend growth rate. So we've got a faster dividend growth rate here. But again, visually you can see that. Now we also see that the company didn't start paying a dividend until 2006, but that dividend has grown every year thereafter. Okay, now the one negative here is that we're looking at a very expensive stock right now. The price is way above the orange line. So these would not necessarily be optimum times to buy it from a long-term point of view. But again, if you were reinvesting dividends every year or every quarter, you could be taking advantage of dollar cost averaging. The blue line on the graph is the normal market multiple. And so these gives you valuation references that you can utilize to evaluate When's a good time to buy, sell, and hold if you were adding capital and buying? I'm going to skip AGNC for a minute because I want to end with that. I'm going to go ahead and move on to Cencora here because this is a very interesting one. I want you to notice here that you've got the weekly closing stock prices, and I want to emphasize this. The orange and blue line here, and they're almost superimposed, they're almost identical, are consistently growing at about 15% a year. So that's a real consistent line. The white line is real consistent, but you also can see that back in 04 and 05, this company was paying almost nothing out of earnings. 3% of their earnings they were paying out, but then they began increasing their payout ratio to 18% and then to 23% and so on. You can also see when it's not a good time to buy the stock, when the price is high, because the earnings, if I look at here, the earnings grew very nicely, but the stock price actually would have lost money over this 4 or 5 year period I've drawn here because you were overpaying for a great company. But in spite of all of that, the dividend continued to grow year after year after year. And so since your number of shares were fixed when you originally bought it, this high price doesn't have any effect on the income you're receiving, but it does have an effect on any new capital that you would be adding to the stock. So moving on here, we move to a Campbell Soup. Now this is a very low growth stock, 3.5%-ish over this last decade, but it's a higher yield than the others. It has 3.1%. Now it is a high quality company. It's got an investment grade rating, a BBB minus, about 52% debt. And it does have a moderately high payout ratio. You can just look at this graph and see that it's paying out about half of their earnings as dividend income. Okay, but you can see that just by looking at the fast graphs. All right, but you also see the unpredictability of the stock price that I've talked about. You see a more fickle earnings line here, but again, it's better or more reliable or predictable than the stock price. But then once again, the white line is the most predictable line on this graph. If you're building a dividend growth stock investor looking for income 20, 30 years from now, that white line becomes your focal point. That's the most predictable and reliable line on any of these graphs, but more importantly, that's the most predictable thing you can think about when you look at a dividend growth stocks for any stock. Now, Elevance I wanted to show because this is a pretty fast-growing dividend growth stock, okay, with a 13.33% historical growth. You can see they didn't start paying a dividend just by powers of observation and then just pointing to the white dot. If you're a Fast Graph subscriber already, click it. Just point to the dot, and it shows you a real low payout ratio. You can see here that the payout ratio stayed about 15 to 20% or so. You just get that visually here. But the company, you can see how earnings follow predictability. Now, we also stack dividends on top of the orange earnings line to illustrate that capital appreciation is the stock price moving from point A to point B, plus you get the dividend income once it's paid out of earnings. So this green shaded area is simply this area here paid out. It's no longer in the investment. It's been paid out as a dividend. The shareholders have received that as a dividend. Okay, very consistent stock. Again, you can go check your performance result and you'll immediately see that it's had a dividend growth rate that's actually been a little higher than its earnings growth rate, but consistent with its dividend growth rate. Okay, and it's also been an outperformer over time too. You can see that kind of easily and quickly. But again, there's a lot of consistency here. It's the reason I chose this. But again, it's only got a 1.22% current yield. So this isn't about what it would be today. This would be about what the dividend will be in the future. So let's examine that, if you will. Let's shorten the time frame to when they first started paying a dividend. Okay, and let's go into the performance report. All right, and now let's look at the dividend was started in 2012, as I pointed out. Make sure I'm right about that. Let me add 1 year to this graph. Okay, actually it was started in 2011. I thought I might have missed it by a year. But I want you to notice the yield was 1.76%. You know, we have this column yield on cost. I like to call this growth yield. Okay, so if I look at the historical graph again real quickly and go to the historical graph, the yield is 1.22%. So the current yield of this stock is a little lower than it was when we were looking at this performance report. But the point I want to get at is you had a modest yield here of 1.76%, but the company grew the dividend each year. Now, by different rates, companies, management, and boards make different rates, but again, the average has been real high, as I've pointed out. But your number of shares have stayed the same, 175.87 in this case. This was on a $10,000 investment. It's just a metaphor. And your yield was 1.76. You got $175.87 per 10,000 invested. But the next year, your dividend went up, okay? And you can see the dividend went from $1 to $1.15, okay? So your yield went from 1.76 yield on cost to 2.02%. Second year, you would have received $200. Third year, $263. And you can see all the way out that last year you'd have got over $1,000 of dividend income alone, over a 10% yield on cost on that factor. And that's the beauty of dividend growth stocks and dividend growth investing. Now, this same factor would apply once you did get there and retired and started needing the income. A good dividend growth stock can continue to give you a raise in pay each year. Now, the next would be Philip Morris. Now, this is a higher yielding stock, has a lot more dividends. I want you to note that the payout ratio is very high, over 75% typically each year. You just point to these little dots here. It's around 74 or 75%. Stock is very undervalued now, okay, but again, the white line is very predictable. In this case, the orange and blue lines are pretty predictable as well. But once again, that feisty, nasty, pesky weekly closing stock price is the most unpredictable thing. But once you've bought a number of shares here, that dividend just grows year after year after year. So this would be an example of a higher yield, high payout stock. Right, the next one we're going to look at is Old Dominion Freight Lines. Now, I just chose this because it's a very expensive stock today, but it's got a good growth history, but a little bit of cyclicality in its growth. They started paying a dividend in 2017 with a very low payout ratio, 9.2%. But as time went on, their payout ratio stayed around 9 or 10% until 2023, where it increased to 14%. And I can see that just by using my powers of observation with the fast graph tool. But this is also a very low yielding dividend stock. So it's not about what this stock is worth today. It's about looking at the performance and looking at the yield on cost chart again and seeing how the yield on cost has increased dramatically year after year after year, every year since they started paying one. That is the beauty of dividend growth stocks. Okay, the next stock on the list would be PepsiCo. Now, this is a stock that always sells at a premium valuation. I'm going to expand the chart out. The market's always put about a 20 multiple. This would be the kind of thing you'd be citing when you're looking at the stock. So right now, on that basis, it looks fully valued, but reasonably valued. Here is a period of time where Pepsi was real inexpensive. Point is, it's got a 3% dividend yield, A+ credit rating, 57% debt to capital, which is okay. And again, the white line is so predictable. The earnings have increased each and every year. So this is another example of what I would call a kind of a below moderate growth. This is not slow growth, but it's below average growth slightly, but it's good growth. And your dividend would have grown accordingly in Pepsi. And I'm just going to move on. Here's Southern Company, which would be another low growth example, very high dividend payout ratio, and a relatively high yield at 3.45%. Okay, but again, these are the different kinds of stocks you can choose from with these different characteristics that you need to pick and choose according to your own risk tolerances, your own investment objectives, etc. Now, I'm going to close this presentation by showing you what I don't think you ought to be investing in as a young dividend growth investor. Maybe if you're an older investor, you could choose these if you want. I personally don't like them. Some people do. And this would be a mortgage REIT like AGNC. Now, I'm going to shorten the time frame here just to illustrate a point. I want you to notice the orange line has been continuously dropping year after year after year. I also want you to notice the white line, the dividend line, has been dropping year after year after year. Okay, I also want you to note that the stock price has been shrinking from $28 a share back here It's averaging about $15 a share here and down to single-digit prices here. And currently it's only around a $10 stock, but it has an extremely high dividend yield of 14.1%. Just call it 14%. Okay, so as a young growth investor with 20, 30 years to wait, I don't think this is the kind of stock you can choose. Now, if you're an older investor that's already retired, let's say, and looking for maximum income, the one advantage these stocks do have is they will end up producing more total dividends than a traditional stock like CVX or whatever. But I do want you to notice something here. You can go into this fast graph tool and you could change this and make it the S&P 500, but for sake of time, I'm not going to do that. But what I want you to notice is the dividends have just been dropping every single year. Your yield on cost did backwards of everything I show, went from 21% back 10 years ago if you'd have bought it in 2010 and dropped to 5.43%. But it did generate a whole bunch of dividend income. And your original $10,000 investment today would have also shrunk dramatically over time. So the reality of it here is that you don't invest in these kind of companies if you're a young investor looking for dividend growth. This is not the kind of characteristics that I was talking about that I wanted you to be looking for. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. I want to just clarify some things about this kind of long presentation I did on this video. This is showing you that there's variety. There's all kind of different dividend growth stocks you can choose. The secrets are start young, be disciplined, do it regularly, focus on what your needs are, what your goals are, monitor, keep track of the portfolio. And one thing you can do with that, with our new portfolio feature that I mentioned with FastGraphs, you can create a portfolio, an advanced portfolio. And I've got one here as an example. Let me go ahead and cut over to it and show it to you. This is an advanced portfolio. I call it 100 baggers. This is a portfolio of 100 baggers. And I haven't put any transactions in here. But I want you to know you can see all this information, the diversity, the names that you have, etc. I might have a better portfolio here. Okay, here's an equal weight dividend growth portfolio that I built a couple of years ago and I've been keeping track of, and I'll be doing more. I'll be updating this soon. This shows the annualized rate of return, the XIIR, shows how much income it's thrown off. It shows the top gainers, the top losers, how the portfolio is performed, what kind of diversification you've got, and you can get that much more granular, what type of sectors that you're investing in. So this is a good example. Each of your holdings, what size of the holdings are, and there's a lot more to this particular type. You can go into the holdings itself. This was a summary, and you can see, keep track of your gains or losses. So this is what I meant by utilizing the FastGraph tool to help you keep track of your portfolios and make better decisions. If you have the right tools, any job is easier. Anyway, I hope you guys enjoyed this presentation. There's all kinds of strategies and nuances to this that could be applied. And again, I wasn't recommending any of these stocks. I want to reiterate that. These were just examples to show what kind of variety that a young investor has. But the key word is discipline. Easier said than done. Thanks for watching. I hope if you liked the video, give me a like, subscribe to the YouTube channel, and subscribe to FastGraphs if you don't. I couldn't even imagine investing in stocks without the benefits it gives. And like I say, it's the value investor's best friend. Thanks for watching.